You're watching episode 43 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and before we get started, I invite you to join our Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Also, check out our premium newsletter and membership site, www.taxsmartinvestors.com. You get a free 14-day trial. You can check out all of our articles, tools, and you get a weekly strategy newsletter on top of the free newsletter that we have. A link to that is also provided in the description below. Today's topic is all about installment sales and what depreciation we recapture whenever we sell real estate on an installment sale. Now, whenever you hear the term depreciation recapture, there's actually three types of depreciation recapture. There's something called Section 1245 gain, there's 1250 gain, and then there's unrecaptured 1250 gain. Section 1245 and Section 1250 gain, those are the first two types of depreciation recapture. That is recaptured at ordinary tax rates. Now, Section 1245, that's any bonus depreciation or any accelerated depreciation that I've taken on my 5 and 7 year property. That's Section 1245 gain. That's going to be recaptured at my ordinary tax rates as high as 37%. My Section 1250 gain is accelerated depreciation in excess of straight line depreciation. So it's a little bit different than Section 1245 gain. Now, the Section 1250 gain in excess of straight line, an example of that would be, let's say that I put in a parking lot that cost me $15,000. Well, if a parking lot costs $15,000 and it has a useful life of 15 years, it's Section 1250 property, but I can bonus depreciate that $15,000 because 15 years is less than 20 years, and per our bonus depreciation rules, we can 100% expense via bonus depreciation any component with a useful life of less than 20 years. So we take this parking lot, we spend $15,000 on it. I immediately write off $15,000 on my tax returns. After 3 years, I sell the building and I sell the parking lot included. 3 years over a straight line method for a $15,000 property or parking lot that would have lasted 15 years, 3 years of that is $3,000. Just you take the asset cost, you divide it by the useful life, that's straight line. So after 3 years of ownership, I sell this parking lot. I should have taken $3,000, but I actually took $15,000. So my excess depreciation over straight line in this example is $15,000 of accelerated bonus depreciation minus the $3,000 of straight line depreciation. So my excess is $12,000. That's going to be my Section 1250 gain. That's bucket number 2 of depreciation recapture. And that is also taxed at ordinary tax rates. So bucket number 1 was my Section 1245 gain, ordinary tax rates. Bucket number 2 is Section 1250 gain. That's any excess over straight line. That's also taxed at ordinary tax rates. My third bucket is my unrecaptured 1250 gain. That is the depreciation that I have taken on the building and in any other type of like 27.5-year component. So any sort of structural or HVAC, roof, anything like that. That's all going to be unrecaptured Section 1250 gain. I'm depreciating those components over 27.5 years. It's straight line, and I do recapture that depreciation, but it's a maximum 25% rate. So full circle, let's get back to the installment sale. I sell my real estate on installment. How am I taxed, or how does that depreciation recapture factor in? If we didn't sell on installment, if we just sold it straight up, we would pay recapture tax on all of our 1245 property, all the depreciation that we've claimed on our Section 1245 property. And again, what is Section 1245 property? It's my 5-year and my 7-year property, my personal properties, my fridges, my appliances, my carpet, my cabinets, anything like that. My Section 1250 property, I'm going to pay ordinary tax rates on that if it's 15-year property and if I accelerated depreciation. And then I'm also going to pay recapture tax on the building depreciation that I've taken over the useful life. So you got to look at your tax returns and you look at all that depreciation that you've taken. You're going to recapture that. When you sell that property, you're going to recapture all of that when you sell that property. Every single dollar of depreciation you've taken, you will recapture when you sell that property. And then again, you just have to figure out what is the tax rate that's going to be applied to all of that recapture based on, whether it's Section 1245 or Section 1250 and what type of Section 1250 property it ultimately is. But just to simplify it, I look at that balance sheet, I look at all the depreciation that I've claimed, I'm going to recapture all of that. But with 5-year and 7-year property, I recapture it at my my ordinary tax rates, maximum 37%. With my 15-year property, any excess over straight line, I recapture my ordinary tax rates, maximum 37%. Anything else is a 25% maximum, and that's my unrecaptured 1250 gain. But when I sell on installment, it's a little bit different. Now, what is installment? That means that I sell you my property, but instead of selling the entire thing and just cashing fully out, I'm going to sell it to you, but I'm going to carry back a note. And the note just ranges depending on whatever our deal is. So I'm going to play bank, right? So you're going to pay me every single month, just like you'd pay a bank. That's selling on installment. But for me, every single month, I've got to recognize principal, right? So I'm going to get some of my basis back because I've got to take the basis of the property, the cost basis of the property, and I've got to spread it out over all the payments that I receive, the upfront down payment plus all the monthly payments. So I'm going to have some cost basis that comes back to me. It's not taxable because it's my cost basis. I'm going to have some gain, and then I'm going to have some interest. So that's going to be part of every single payment that I receive on installment over the lifetime of the note. Additionally, I just told you that each one of those monthly payments that I'm going to receive by seller financing a property, basically installment sale, each one of those monthly payments that I'm going to receive is going to include cost basis principal, it's going to include gain, and it's going to include interest. But here's the rub. With my unrecaptured Section 1250 gain, that's all the depreciation, again, that I've claimed on my 27.5-year or 39-year components. I have to recapture that fully first. So every monthly payment that I receive, the gain associated with that monthly payment will be my unrecaptured 1250 gain before it's ever going to be the gain from appreciation, Section 1231 gain. So what does this mean? Well, let's walk through an example. So I sell a property. I have $50,000 of Section 1245 and Section 1250 gain. I have $100,000 of unrecaptured Section 1250 gain, and I have $100,000 of actual capital gain. And I'm going to engage the buyer in a seller finance transaction, meaning I'm selling my property to the buyer on installment, and the buyer is going to make a payment to me every month. And let's just say the note term is 20 years. So I have $100,000 of gain from appreciation. That's my 1231 gain. I have $100,000 of gain from depreciation. That's my unrecaptured Section 1250 gain. And then I also have $50,000 of gain coming from my Section 1245 property and my Section 1250 property, where I've taken depreciation in excess of straight line. Now, I'm just making these numbers up. So the first year that I sell this property, in the year that I sell the property, I've got to recognize that full $50,000 of gain associated with my Section 1245 property and my Section 1250 property, accelerated depreciation in excess of straight line. So I'm going to pay my ordinary tax rate on that first $50,000 of gain. The next $100,000 related to depreciation was from my unrecaptured Section 1250 gain. On that, I'm going to spread out recognition of that gain through all the payments that I receive. Now, let's assume every year I receive $20,000 worth of payments, but $10,000 worth of that payments every single year is the gain portion of those payments. So I receive $20,000 of payments a year, but $10,000 of that is attributed to the gain. Because I have $100,000 of unrecaptured Section 1250 gain, I'm going to first recognize all $100,000 of that unrecaptured Section 1250 gain each year with those $10,000 of gain built into those payments. So it's going to take me 10 years to recognize the unrecaptured Section 1250 gain that was associated with this sale. Starting in year 11, the $10,000 of gain associated with every year's $20,000 of payments will then be my Section 1231 gain, the gain from appreciation. So it's really important to understand in this instance that for the first 10 years, the gain portion from my installment payments is going to be taxed at a maximum rate of 25%. I'm not going to get to spread my long-term capital gains out because I first have to fully recognize the unrecaptured Section 1250 gain. The gain coming from the depreciation that I've claimed on my buildings, my 27.5-year, 39-year property. I recognize all of that first before I recognize and pay taxes on the long-term capital gain, the gain from appreciation. So in summary, there's 3 types of depreciation recapture. There's Section 1245 gain, there's Section 1250 gain, and there's unrecaptured Section 1250 gain. The first 2, Section 1245 and 1250 gain, I recapture at my ordinary tax rates, and I have to pay those upfront in the year of sale when I have an installment sale. That third bucket, unrecaptured Section 1250 gain, that's taxed at a maximum 25% rate, and that can be spread out with my installment payments over time. But I have to recognize that gain to the fullest before I'm able to start recognizing gain from the actual appreciation of the asset. I hope that you enjoyed today's episode of the Tax Smart Daily. If you have any questions or if anything that I said resonates with you, drop me a comment below. I love engaging with our community. And check us out on all of our social media platforms. We've linked up everything below. And like I said, we'd love to have you in that Facebook group.